Welcome to this week's ASX edition of Trade the Trend, a weekly video discussing where the stock market is heading. In this video, I'm going to be discussing the ASX 200. I'm also going to tell you about the danger of having high conviction when it comes to the stock market. If you're interested in the S&P 500, I've covered that in a separate video and I'll leave a link for that in the description section below. As always, it's general commentary and doesn't take your personal situation into account. All right, with that said, let's go to our first chart. So what we have on the screen is the ASX 200. And this continued to trade in a tight range over the last week. And it remains capped below this big resistance band, which is between 6,750 and 6,900. It's also worth noting where the moving averages are. So I'm just going to put those on the screen now. So this is our 50 and our 100-day moving averages. And I think while the ASX 200 remains below this resistance band and below the moving averages, I think the underlying position remains vulnerable. It just remains a vulnerable market whilst those situations remain in place. And if you've seen my analysis of the S&P 500, you know that I talked about the possibility of a bear market rally. And if that were to happen, then it would be natural for the ASX 200 to probably rally as well. But look, I think given the weak technical picture, I just don't want to preempt a rally. I don't want to preempt a rally in this market, and I don't want to try picking the low. I think we need to continue playing defense until the market tells us otherwise. I'd rather be late to a new bull market than try picking the low and then having the market run over the top of me. And I've got to tell you that over time, I've seen that happen to so many people during these bearish phases. And what happens is you get people that come in, they're continually trying to pick the low, they're continually trying to buy the dip, and the market just keeps beating them up. And I think if the US market were to rally, there's nothing saying that the ASX 200 couldn't do something like this. The ASX 200 couldn't, maybe it would like rally, it would edge higher, it'd test back into this resistance band, but then we could find that from there, it then starts to roll over again. So that's not a prediction. It's just showing how it possibly could map out if we did see strength in the US. The Aussie market could rally too. But if it remains capped below this resistance band, it remains, in my view, a vulnerable market. So I think at the moment, there's not much to get bullish about right here and now. It's, it just doesn't seem to be in a strong position. Now, I want to go over and have a look at the Small Ordinaries, ASX Small Ordinaries, because that's been interesting this week as well. Now, what I'm mindful of here, I'm mindful that where the price is, it is currently getting quite stretched away from its 100-day moving average. And there's a possibility that from where we are now, that it does keep sort of like edging higher and then starts to get some momentum. You could, it's not out of the question that we see something like that develop. It's not my base case, but it is. But I am mindful that we are so far below these averages that it could try and snap back. But I think the pattern to watch. I think the pattern which has the most probability of panning out. It's this little lagging type pattern which has been developing over the last 3 weeks, similar to what we saw through this period through here. At another one. I often see these during market declines where the market pauses to consolidate and then breaks down again. So the risk is that this pattern does break to the downside, and over the next could be the next week or so, we do see it come down and break to a new low. That's a concern I have with the local market. And look, the local small caps have been hit really hard. When we look at like where they came from at the March lows in 2020, from their highs in November last year, they were down something like 27% at the lows. So it's a really big fall. And I think there's probably a lot of fear, and there's a lack of liquidity in these small caps generally. And I know that from exiting stocks in my own portfolio where they've got lower liquidity, it's been really difficult to get some of those stocks away. So for a fund manager trying to liquidate these smaller stocks, it's one of the things which could really be driving these smaller caps lower. And I think at some point, this is going to present a really good opportunity to get back in. And one of the ways which I've been looking at to potentially playing that is through a Small Ordinaries ETF. So iShares have one. The stock code is ISO. So I won't show it on the screen today because it looks pretty much like this does. And I don't think we're there yet because there is that potential for this market to fall down, make a new low. But it's a market which I'm closely watching for a potential opportunity. And it's one I'll continue to look at in this weekly video. The ETF approach could be a way of getting back in because it probably does lower some of the risk of trying to approach the small caps from individual stocks, at least until stocks start to stabilize more and we start to see these moving averages turn and more momentum in general coming back into the sector. But look, let's just keep an eye on this one. Now, I want to show you an article that I saw through the week, which I found really interesting to have a look at. And look, before I show you that, just quickly, if you're getting some value from this, please hit that like button and please leave a short comment. Just, hey, thanks for the video. That'd be fantastic if you could please do that, because it shows YouTube that people are watching, people are engaging, and then YouTube will show more people, and that helps me build my YouTube channel because it takes a lot of time and effort. It takes really half a day it's only a short video, but it takes about half the day to do a couple of them because I've got to plan them out and do a lot of research, a lot of thinking, getting my thoughts nice and clear so I can explain them to you. So please do that for me. And also come over to my Motion Trader website if you haven't already and have a look at what I do over there. All right, now this is the article I want to show you. So it turned up on Livewire, which provides a whole lot of free resource, a whole lot of articles about what fund managers are saying and what people think of their stock ideas and so on. And you can look this one up yourself if you'd like to read it in more detail. How the number one picks went from hero to zero in just 6 months. And so what I'm doing here now, this isn't about talking anyone down. It's not about doing that by any stretch, because successful investing isn't easy, and it's especially difficult when you're asked to make a prediction 12 months into the future, because so much can change. So much can change a lot can change in a month, let alone over a year. And I believe it's really important to be able to adapt to changing circumstances and not have rigid views where we say, well, this is what's going to happen in whatever time period it may be. And as I'm always telling my Motion Trader members, it's okay to get things wrong. And that's why I use stop losses, and why I say it's worth taking small losses and then walking away. What I want to highlight here, I want to highlight the danger of high conviction calls, because this is what this article is all about. It's about asking people to make high conviction calls, because high conviction often involves ego. And when ego comes into the picture, it can often be harder to walk away when it's not working. So I want to show you this section in particular. So let's just read this. While 2 of our 18 fund managers have sold out of their top stocks for 2022, the remaining 16 stock pickers are adamant that their highest conviction calls remain compelling over the months and years to come. Now, from my perspective, this is just my perspective. I know it's shared by a lot of highly successful traders as well. The market doesn't care what we're adamant about. The number one rule of investing, it's about people think the number one rule of investing is to make money. It's actually not right. That's rule number 2. Rule number 1 is to protect your capital. And that means not being right all the time. And I think one of the most dangerous things you can do is to argue with the market. That's why I use stop losses, and that's why I use stop losses for my motion trader service. I want to protect capital when an idea isn't working. So I just want to quickly look at a couple of stocks from this article. And some of the stocks in the article, look okay. They look interesting, but others are a disaster. I'm just going to go through a couple of them just so we can get an idea of like how this high conviction stuff can play out. So one of the stocks is a company called Razinvest, RZI. Let's get a chart up here. This is actually a stock that appeared in my motion trader service a while ago. I gave a buy signal for this one. My system gave a buy signal for this. It was around August. June, July, where are we? Somewhere in here. Got a buy signal in there as the moving averages were positive. The price is breaking out. Got a buy signal, but as a lot of stocks do, it lost momentum and it fell back. And then I got an exit signal in January. So it's around here. So buy there, didn't work out, sell there, move on to the next opportunity. Clear, clinical, no ego involved, didn't work, so what? Lost a relatively small amount of capital. Now, what the guy in this article is talking about, he's arguing that he hasn't moved on like I've just described there. He backed this as being one of his top picks around here at the start of the year, and it's now down I think it's down something like, let's just measure that out. Been down as much as 65%. Okay, so from my perspective, the market's saying that being long here is wrong. It was time. There's been a clear point to move on. The moving averages have turned higher. As I'm often saying, the bad stuff happens below the moving averages, and that's certainly been the case. But this fund manager is arguing that there's a disconnect. The market doesn't get it, and he remains fully invested. So maybe it'll work out, maybe it won't. But I think fighting the market like this is a way to lose capital over time. Because as I said, the market doesn't care what you think. Now, another stock we'll have a look at is it's a US listed one. Zebra Technologies. So again, you've got let's look at the chart. So where are we in January? This is the start of the year when the call's presumably made. It's fallen since then. That's okay. Don't get everything right. Use an exit stop, get out of the position. Moving averages have turned lower. Bad stuff happens below the moving averages. That's continued to happen. Down at this point here, once you get down here, why are we still holding this stock? It's trending lower. It's breaking down. Well, it's already broken down. It's costing money. It's a capital destroying stock. But the manager argues that it's a good stock. He really likes it, and he's been averaging down as the stock's been falling. So look, I don't mean to criticise anyone's approaches, and I'm not being critical of anyone, but just talking about process in general. I don't like averaging down in losing stocks because you never know how far they're going to fall and how long they're going to take to recover, and even if they're going to recover. I think it's a dangerous strategy, and it's great when you're right. But what if you're not? What if you're not right? I think really it all comes down to risk management. Risk management and protecting your capital is just so important, because once your capital's gone, you can't play the game, and you need your capital to stay in there. So look, I hope you found that interesting. It's an interesting article to go back and have a look at if you'd like to learn a little bit more about it. But otherwise, look, I think where the markets are at the moment, I think we need to stay defensive. It's about taking caution at the moment. We just got to wait. Just got to wait for that price action to give us some clear signs as to when larger trends come back into play. They will do so, but it'll be on the market's time frame, not on ours. Okay, I hope that was helpful. Please give me that like. Look forward to speaking to you next week. Bye for now.